I'm Justin Charlton-Jones. I'm a business growth specialist, and I'm going to talk to you about why profitable companies can run out of cash when they grow and how to fix it. Business growth is often viewed as the ultimate validation of business success. You have rising revenue, your margins look healthy, the sales pipeline is strong. Yet many profitable businesses encounter a paradox during scale-up. They run out of cash. I'm going to explain why this happens, the structural causes behind cash flow pressure in growing businesses, and the practical steps that business owners can take to maintain financial control whilst still growing their business. The paradox behind growth is that profit does not equal cash. As I'm sure any of you who are business owners know, a business can show strong profits on paper while simultaneously facing severe cash shortages. That's because profit is an accounting concept. Cash, however, is operational reality. And when companies are growing quickly, three forces typically collide. Your working capital requirements increase, your operational complexity expands, and the cash timing gaps get wider. Understanding these is the first step towards solving the problem. So why do profitable companies run out of cash when they're growing? Here are 6 reasons why you might experience cash flow issues as you grow. The first is working capital expansion. As revenue increases, so does the amount of money tied up in accounts receivable, stock, work in progress, deposits and prepayments. For example, a business which doubles its turnover from £2 million to £4 million may need significantly more cash just to fund larger invoices waiting to be paid. Growth consumes cash before it generates it. Secondly, there's the accounts receivable trap. Many companies experiencing significant growth extend their credit terms in order to win larger clients. But if your average debtor days increase from 30 to 60 days, whilst your sales double, then your business is effectively financing its customers. This is a particularly common problem in B2B environments and project-based businesses. The third area is inventory strain. Product-based businesses often have to increase their stock levels to avoid running out of stock, support new product lines, expand into new markets. However, your inventory does not generate cash until it's sold and paid for. So poor inventory forecasting during scale-up can be a major drain on the business's cash. The fourth issue is upfront hiring and infrastructure costs. To support growth, businesses typically invest in senior hires, sales team, marketing campaigns, systems and software, larger premises maybe. All of these costs occur immediately, but it can be months before the revenue uplift follows. This timing gap creates cash flow tension. A fifth point is that margins are often affected during expansion. Growth can temporarily reduce your profit margins due to discounting to win market share, inefficiencies while onboarding new staff, increased operational errors, and overhead costs which increase before your increased capacity is being fully utilised. So even if the company's annual profit remains positive, monthly cash deficits can still emerge. And finally, tax and VAT surprises can hit your cash flow. Rapid revenue growth will increase your corporation tax liabilities, your VAT payments, your PAYE and payroll obligations. So without proactive forecasting and ideally saving a proportion of your revenue into a tax-dedicated account, tax bills can create sudden shocks and liquidity pressure. Many businesses face the greatest financial risk when they're moving from around 1 million to 5 million turnover, or if they're moving from a founder-led to a management-led organisation, or they're having to replace informal systems with structured operations. This phase of growth often involves delegation of financial oversight, reduced visibility of the business's cash position, and an assumption that more sales will fix everything. In reality, unmanaged growth magnifies structural weaknesses in your business. So watch out for these early warning signs of cash stress. Business owners should watch out for increased overdraft usage, supplier payment delays, rising debtor days, cash juggling where you rob Peter to pay Paul, stress around payroll dates, and growth that's funded entirely by short-term borrowing. If your revenue is rising but your financial anxiety is also increasing, it's time to intervene. So how do we fix cash flow problems created by periods of strong growth? Well, here are 6 tactics. The first one is implement a rolling 13-week cash flow forecast. A weekly rolling forecast provides clarity on expected inflows, committed outflows, where your cash gaps are, your funding requirements. This becomes the operational dashboard when you're scaling your business. The second is manage your working capital deliberately. Key actions include tightening your credit control, incentivizing early payment from your customers, renegotiating terms with your suppliers, reducing slow-moving stock, structured milestone-based billing. Cash discipline must increase in line with the growth in revenue. The third point is align your growth with your cash capacity. Not all growth is healthy. Businesses need to evaluate the customer profitability, contract payment terms, gross margin by segment, and the true cost of servicing those clients. Scaling unprofitable or cash-heavy contracts will just accelerate failure. The fourth point is secure the growth capital you need before your need becomes urgent. So options open to you may include bank facilities, invoice financing, asset-based lending, private investment, and retained profit reinvestment. But the worst time to try to raise funding is when cash is already critical. The fifth point is to strengthen the financial leadership in the business. During scale-up, your financial oversight needs to evolve. It needs to move beyond basic bookkeeping. You need to introduce management accounts, track your KPIs weekly, not quarterly. Consider hiring a part-time financial director or CFO. Financial visibility enables consistent growth and good decision-making. And the final point is improve your pricing strategy. Many fast-growing businesses underprice themselves. Small margin improvements can dramatically improve your cash generation. So, for example, a 3% gross margin increase may double your net profit. Improved deposit requirements can reduce working capital strain. Pricing discipline is often the fastest route to improved liquidity. So, if your business is growing quickly, you may need a strategic mindset shift. To grow your business with control, not just speed, your growth needs to be planned, funded, forecasted, and measured. Scaling up without financial planning and structure is not ambitious, it is a risk. The most successful scale-ups balance their revenue expansion, their operational capability, and their cash resilience. You might also like to think about how an experienced business coach can help you during scale-up. They can provide your management team with financial clarity and accountability, strategic growth planning, cash flow forecasting discipline, leadership development during transition, and an independent perspective which questions expansion decisions. Growth decisions will become structured rather than reactive, and the result is sustainable growth rather than fragile expansion. So, to summarize, profitability alone does not protect a business during growth. Scaling up amplifies working capital pressure, operational complexity, and financial risk. Without disciplined forecasting and strategic oversight, even strong companies can experience cash crises. However, with the right financial systems, pricing strategy, and leadership discipline, businesses can scale confidently, protecting both their liquidity and long-term value. Growth should create freedom, not financial strain. If you'd like a copy of our white paper on this topic, then please visit our website or else get in touch to request a copy. I'm Justin Charlton-Jones, and thank you for listening.